Hello traders and welcome back to the Forex Geek where we dive deep into the tools that can help you make smarter trading decisions. In today's video we are going to discuss the EMA reversal strategy, which is a straightforward method to identify potential trend reversals in the Forex market. You'll learn how to set it up, spot entry points and avoid common mistakes. Stay with me until the end to fully understand how this strategy can improve your trading approach. So without wasting much of your time, let's get started. So we're talking about the EMA, and this is a very popular moving average used in the market, widely used. It's called the exponential moving average, and it's a technical indicator that focuses on recent price data, giving it more weight compared to older data. This makes it more responsive to price changes than the simple moving average. And for every sharp movement in price, you will see the EMA reacting quickly to it compared to the simple moving average. Traders often use the EMA to identify trends and potential reversals in the market. We are talking about EMA reversal, and this strategy revolves around using two EMAs with different periods, a short-term EMA and a long-term EMA. And with this, we'll be able to spot when the market is about to reverse. Just like as you can see here, we are bullish. And how can we tell when the market actually wants to reverse? Could be a pullback before the continuation. How can we tell? Now, that is where the EMA reversal strategy comes in, and I advise you watch this video to end to learn this strategy properly. So, like I said, the strategy revolves around using two EMAs with different periods, a short-term EMA and a long-term EMA. Now, the short-term EMA tracks recent price movements, while the long-term EMA reflects broader market trends. So when these two EMAs cross each other, it can indicate a potential shift in market direction. So I'm just going to add the two EMAs to the chart. Advise you use the 21 period EMA for your short term and use the 55 period EMA for your long term. And you can see the 55 is the red line, the red EMA, one with red color. And now we have these two EMAs on our chart. Now we are talking about how to know when price will likely give us that reversal using the EMA. Now, as you can see, the short-term EMA crossing above the long-term EMA often signals that buyers are gaining control, potentially leading to an upward trend or reversal. Maybe we are in a bearish trend just like we are here. We've been bearish using the moving average as dynamic resistance. And moving all the way down. So how do we tell that market is about to switch from bearish to bullish? As you can see, we've spotted this cross. This crossover didn't happen all the way here. See where it happened? It happened here. So after spotting this crossover, the next step is to look for opportunities for this reversal. Now you should know that this reversal may be short-term reversal. It's not something that you're going to say, okay, we are now totally bullish until you get that confirmation that yes, we are now bullish before we've changed the trend from bullish to bearish trend or bearish to bullish trend before you can fully enter the market. On the other hand, when the short-term EMA crosses below the long-term EMA, it may suggest that sellers are dominating, and this should lead to a downward trend. And you can see that happening around here. We have this crossover and sellers dominated just for a little bit um, before price seems like it wants to give a crossover here also for a potential reversal back to the upside to continue this bullish trend. Who knows? Now, the strategy works well in trending market because it helps you visualize the flow of momentum. However, it's important to note that crossovers can sometimes occur during sideways markets, and this could lead to false signals. So I advise that you trade using this EMA strategy only on trending markets, not on sideways market. This is a sideways market, and it is wrong. It is totally wrong to trade in sideways markets like this one. So wait for price when it's trending clearly and try to spot those reversals from bullish to bearish, from bearish to bullish. which is what we are talking about, the EMA reversal strategy. So if you focus on understanding how these EMAs interact with price action, and the goal here is to use them as a guide to spot areas where momentum may be shifting. Now, once you've seen these areas where we might be looking for a reversal, it is not advisable to just place your entry to buy or to sell. Always use price action to confirm your entries. For example, here you can see that we have this crossover signaling that we are no more bullish, we are now bearish. We should be expecting a bearish reversal. Our price has been moving bullish all the way, then we have this double top, this M pattern, and at the same time you have this crossover, a break of the neckline happening here. So you can use other factors to confirm your trade, not just relying solely on this crossover, because sometimes it could generate false signals like you can see here. It's a false signal happening here, and traders who bought targeting areas like this would have taken a loss before they were able to hit their target, or areas like this have taken a loss also. So always ensure you incorporate other factors into your trades before taking into this crossover before taking any trade off of it. So after you've incorporated that, you can use your candlestick patterns or your normal price action to take your trades. You can see this bearish engulfing candlestick pattern here, which we can use to take our trades off of this EMA reversal. And taking that trade, we have a 1:2, 1:3, all entering in, and you could also target significant support levels like this one, or you could target all the way down, or you could also trail your stop loss and follow price as it moves all the way down to be able to capture gains. Now you have another opportunity here. You can see this reversal happening right here, and at the same time we have this big momentum, this big bearish momentum in the market, confirming the trade. So here we have a bit of structure and price giving us this pullback and using the moving averages as dynamic resistance before continuing its push to the downside. Stop loss above the high and take profits all the way down. So it's very simple. Once you spot the crossover, that is, it could be a sign for a reversal. Look for price action, look for candlestick patterns which you can use to take trades off of that to give you that reversal that you need from bullish to bearish and from bearish to bullish. So common mistakes you should avoid, I've talked about it, relying solely on EMA crossovers without additional confirmation. This can lead to false signals, especially in sideways markets, and we've talked about that. And also, ignoring the broader market context is another common mistake. As you can see, we have been bearish here. So, looking at this crossover happening here, I wouldn't say that we should just suddenly switch to bullish here. We should wait for additional confirmation. So, as you can see, we have been bearish for the longest, and we have this crossover happening here. Have this crossover happening here. So you have to actually wait for additional confirmation. Looking at the broader market context, we are bearish and we have this crossover, and this is a choppy market. And the broader market context is bearish. I wouldn't necessarily be taking a bearish trade here. Actually, wait for market to give me that confirmation, which is why looking at the overall market context is very crucial, very important, because it helps safeguard you from false trades and false signals. Also, there could be economic news or major events or overall sentiments that can significantly impact price movements and invalidate technical signals. So always consider what's happening in the larger market environment before entering a trade. Like I know that this what happened right here would have been a major technical event that happened here. It could be news, economic event. I mean, it could have been an effect of a news that was released. So traders who were looking to buy based off of this would have they would have taken a loss because they didn't put into they didn't factor in this economic news which came in just a few days later. So it's always important to put these things in context when trading with the EMA reversal strategy. Also, you can use tools like ATR to set your stop loss. Ensure you always prioritize risk management. It is very, very important. Overtrading based on every EMA crossover is another mistake to avoid. Not every crossover will result in a meaningful trade reversal. It's not every crossover that will result in a good trade. You can see this one happening here, even this one here, which I've showed you already. So focus on quality setups that align with other factors like candlestick patterns or support and resistance levels. Alright traders, you've come to the end of today's video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, don't forget to like, subscribe and turn on the notification bell so you never miss out on trading tips and strategies. Thanks for watching and I'll see you in the next video.